All right. Welcome, everybody, to our second installment in our financial health series, co sponsored here with Providence CPAs. Today, we're going to be talking about financial strategies to reduce risk. I think I've shared this with some of you guys before. Prior to my life in medicine, actually, I was an econ and finance guy. I know enough now to be dangerous, which is why I am also a client of Providence and why I wanted to share this with you guys. Today, our guest speaker is Bill Bennett. Bill is a financial architect with over 18 years of experience helping physicians and other healthcare professionals build wealth and achieve financial independence. Bill, like David, graduated from OSU. He's another cowboy. He had degrees in accounting and finance. He's passionate about educating healthcare providers on smart financial decisions and has spoken at events nationwide on the topic. And so we're excited to have Bill here today. And without further ado, I'll give you the man of the hour. Bill Bennett.
Hey, thanks so much. Really excited to be here, and we've got a couple of other guests from Provident on the line. I think Angie's going to make some introductions, go over a few things, and we'll dive into the content.
All right. Thank you, Bill. Yes, I would do want to make a few introductions. I'm Angie O'Day. I'm the Client Success Manager at Provident. We also have David Auer. He is the owner and founder of Provident and Physician Tax Solutions. And then also we have Todd Hudgens. Todd specializes in estate and asset protection planning. Todd is also a CPA and tax attorney with an LLM in tax.
Hello, everyone.
So just to touch on some upcoming webinars, part 3 will be October 9th, and the topic will be estate planning for healthcare providers. Then we'll have part 4, October 30th. So the private insurance advantage will be the topic. And don't forget, you can scan the QR code to register for these upcoming webinars. So the agenda is going to be great today. First off, we're going to talk about protection. Then Bill will go into liquidity, 3, diversification, and lastly, next steps and what that can look like. And just a quick disclaimer, everything that we discussed today regarding tax planning and advice will be within the 4 corners of the tax laws.
Thanks so much, Angie, and it is an honor and a privilege to be able to speak with you guys. As mentioned, my name is Bill Bennett, and been at this 18 years now, and have an absolute passion for medicine, and found an avenue to join together my passion and love for medicine and my passion and love for finance, and join them together. So, to give you guys a little bit of background on myself, I was actually a biomedical sciences pre-med major for my first 2 years of undergrad. And I changed majors halfway through my undergrad simply because I had a disabled mother that I was taking care of financially, and continuing to postpone, what I call big boy income to go through the training of medical school residency, and was not going to be a viable option to continue to be able to provide and care for my mother. And so I switched majors and got my degrees in accounting and finance, and have a passion for that, and have a passion for medicine. And so I found a way that I could marry those two together, and it's been my purpose ever since to be able to educate, on financial literacy within the healthcare profession, and be able to ensure that the folks that I work with are able to make informed and educated decisions regarding their financials. Everything from proper protections in place, wealth building, money management, cash flow management, debt management, and everything in between. So today's topic, though, we're going to talk quite a bit on protection, and the reason being is, most of my clients that I work with, they will hear me say this often, but you should only have to build your wealth once. And there are certain curveballs that can get thrown our way that can impact our wealth building potential significantly. However, if we have the proper protections in place, then we can ensure that what our wealth building curve is projected to be can continue to be realized, because in the event that some of the unforeseen circumstances that I'm going to cover today occur to one of us, if we do have the proper protections in place, then we are able to continue going down that road of our wealth building curve. And so, how does wealth building work? And I think it's important. So I call this the law of parallel paths. But you, me, and everybody in between, regardless of profession, regardless of age, we all are on a similar journey where we've got these parallel paths of protection, which is mainly liability, protections from liability, lawsuits, so protections from a premature death, as well as a disabling event, something that, an injury or an illness that would prevent us from working for an extended period of time. And so when it comes to getting the proper protections, it really comes down to the type, the amount, and the positioning that we have in place. But see, this other parallel path that we're on, the one that everyone really likes to talk about, is the wealth building path. And when we're talking about building wealth, what we're really talking about is capital, right? We've got to be able to save and invest consistently and have a disciplined approach to it over time to be able to build wealth. And what we know to be true in regards to building wealth is this is what the wealth building curve looks like, right? It's slow and steady in the earlier years, unless we inherit a substantial amount of money. It's kind of slow and steady, slow and steady. Discipline wins the race. And the way that compound interest works is we really start to see our curve, this wealth building curve, take off in the later years of our working years. And so what we know to be true is about 90% of this wealth building curve is not realized until our last 7 to 10 working years. That's when we're at our peak earning years. That's when we have the most minimal or no debt at all, and we're able to save and invest more money, as well as when compound interest really starts to take effect. And the way I always explain that is, 10% of $100,000 it's only 10,000 bucks. But 10%, the same 10%, the same rate of return on $5 million is 500,000, right? And so you can really see this wealth building curve take off in those later working years. What that also means is there's a substantial period of time that we've got to protect our wealth building curve's ability to be realized. So if we're not going to realize the majority of our wealth building curve in our last 7 to 10 working years, that means we've got 20, 30, maybe 40 years that we've got to be able to protect that curve becoming a reality. And so working with physicians and healthcare professionals all over the country, what I've found to be true is that they would say that they would rather have a 100% certainty of getting to just 95% of their wealth building potential versus a 60 to 70% possibility of getting all the way full 100% of it. And essentially what that means is it may take away about 5% of your wealth building potential to have the proper protections in place, but you now have 100% certainty of being able to achieve that. Whereas if we don't have the proper protections in place, yes, we're not paying the expenses to get the protections. So we may very well get to 100% of our wealth building potential, but at that point, there's really only a 60 to 70% possibility of getting there based on what data shows us with some of these events that could take place, okay? And so when I talk about the three main threats that are facing physicians, there's obviously significantly more. But in the world that I live in, the first and biggest main threat that we find is at-fault automobile accidents. And it sounds crazy, but you can drive across basically any major metro area in the US, and off the side of the interstate on both sides, you're going to find about 80% of the billboards are going to be for personal injury attorneys. It is a big, big, big business. And the reason is because, when you're a high income earner, somebody who, earns a lot, makes a lot, has the potential to have wealth, and you're at fault in an auto accident, oftentimes our liability protections aren't going to be enough on our auto insurance to take care of, an unfortunate lawsuit. And the way that auto and homeowners insurance is marketed, it's all about rate. Think about every commercial that you see, right? Like all the Geico commercials, right? 15 minutes can save you 15%. And so it's always marketed on rate, and very rarely will you find an insurance company or an insurance agent discuss and talk about what's called an umbrella policy. See, an umbrella policy is liability coverage, like an umbrella, over your auto and homeowners insurance for liability protection. And it's sold in $1 million increments. And we encourage all of our clients that you should own at a minimum a $1 million umbrella policy up to whatever your net worth is. And this ensures that you have the proper protections in place in the event that you have an automobile accident that you're at fault in. And additionally, it's one of the cheapest forms of insurance that you can obtain in the marketplace. So for $1 million in coverage, it may cost you somewhere between 18 to 25 bucks a month. And that is generally, that's going to be around 3 to 5 times what your existing coverage is on just your auto and home from the liability standpoint. And so we strongly encourage and recommend umbrella insurance policies to protect ourselves in the event of lawsuits from an at-fault auto accident. The second main threat that we see affecting, wealth building potential is a premature death. So obviously that means that, we've got to have the proper life insurance in place. And there's also this concept out there that's called human life value. And it's very rarely talked about. Generally, an insurance agent is basically just going to ask you how much coverage you want, or how much you can afford. What price point are you looking for? Instead, the better question that people need to be asking is, what is our human life value? Now, this was a factor that was determined right after 9/11, and the government had to figure out how they were going to compensate the families of the first responders. And so they determined this factor called a human life value. And essentially what it is it takes whatever your current income is and multiplies it out from your current age until you're 65 years old with a cap of 30. So for somebody, let's say that's 40 years old, whatever their current income is, multiply that times 25, and that would be what that individual person's human life value is. That's the value, not factoring in inflation or pay raises, but that is the value that that individual, the economic value that they bring to their family between now and retirement age. And so we educate a lot on obtaining human life value of coverage. And then we educate on what types of life insurance exist, right? You have term life insurance, and you have several forms of permanent life insurance. And so we educate on what each of those are and what they can and will mean to you and your family. Additionally, from an estate planning perspective, and I know at our last webinar, David spoke a little bit on estate tax planning. And I know Todd is going to speak on estate planning down the road. But life insurance can play a very valuable piece of the overall puzzle for an estate plan. Because there are some things that you can do with life insurance death benefit, which by nature, by law, is a tax-free benefit. And so it can be utilized as a tool to actually offset whatever estate taxes you may expose your heirs, your beneficiaries to. And so, but for the sake of protection, if a physician were to pass away and let's say their spouse doesn't work outside of the home, that would create a devastating effect on the family financially and what their wealth building plan looks like. However, if they own life insurance up to around what their human life value is, now the family can go on, they can mourn properly and not be in an economic bind because there was no life insurance in place. And then the third one, and this is the one that we see most common with healthcare professionals in terms of questions about it, obtaining it, is illness or injury. So any type of an illness or injury that would prevent you from working for an extended period of time. And so because of that, healthcare professionals, it's never really a question of if they will own individual disability insurance. Generally, the question just becomes, when do they purchase it and what type do they get? And so from a disability insurance perspective, I'm going to dive into a little bit further detail. And so I would love that for anybody that's on this call, the one main takeaway that I want you to have in regards to disability insurance is this quote here that not all are created equal. So, not all are created equal. Individual disability insurance is a contractual agreement between an insurance company and the insured. Okay. And because it is a contractual agreement, there is language written into each and every one of these contracts, and not all are created equal. Okay. And so when looking at disability insurance, there's two main factors to look at when deciding to purchase an individual disability insurance policy. And the first main factor that we always want to look at is what is the strength of the company? Financially, is this company strong enough to be able to pay out benefits for an extended period of time, even if they have a run of benefits, meaning they have a lot of clients in a short amount of time that are making claims? Do they have the financial stability to continue to make those claim payments? And then the second main factor that we look at is the strength of the contract. Okay. And so dive in on the strength of the company. In the insurance world, specifically with disability insurance, this really comes down to what is called a Comdex score. Now, this is a composite of the various ratings that a company has received. So I want to be clear though, this is not an actual rating. What this is it is a percentile ranking on a scale of 1 to 100 in relation to other companies that have been evaluated by at least 2 of the 4 rating agencies. And so when you're looking at purchasing individual disability insurance, or when you're just looking at evaluating what you currently own, you want to look at the company that you own it through and see what their Comdex score is. Very simply, if it's not a 90 or better, it's probably not a company that a healthcare professional should own a disability insurance policy through. Okay. There is one company in the US. No, there's 2 now. There are 2 companies in the US that actually score right at 100. So they are the best of the best of the best in regards to financial strength. There is one company that sits at a 99, and then there's a whole list that are in the 90s or better. But you want to make sure that you're looking at 90 or better. Now, the second factor that we look at is the strength of the contract, okay? And so I'm going to walk through a few key pieces. I'm just going to hit high level on the bullet points and go into a few details on each. But this is where it becomes extremely critical that you understand what you're purchasing, because these are like 80-page contracts and they can all look the same on the front. Pages 1 through 10 of every single contract may look identical, but it's when you start diving into, page 12, paragraph 4, line 7, there's wording there that makes this either a really good contract or a very poor contract, specifically for healthcare professionals. Okay. And so the first thing we want to look at is we want to have a non-cancelable and guaranteed renewable contract. What this means, this doesn't mean that you can't cancel it. But what this means is that no matter what happens to you medically over your working career, as long as you are paying your premiums on time, the insurance company cannot take away this contract. They cannot cancel it, and they are required contractually to renew the contract each and every year. The second main thing to look for in the strength of a contract is the type. So you're going to see any OC versus true own OC. All right. And any occupation policy is not what a healthcare professional should own for an individual disability insurance contract. Okay. Because the way the language reads is that if you cannot perform the material or substantial duties of any legal occupation in the US, then they will make a claim. The problem is you have a very skilled profession. You have a profession that you sacrificed a ton of time, a ton of money to be able to obtain. And so you want to make sure that if they just say, well, you know what, I understand you can't function as a cardiologist or let's say as a nurse practitioner. I understand you can't do that, but we do believe that legally you can go flip burgers at McDonald's. They don't have to pay a claim. That is a problem for individuals that have very skilled professional occupations. So you have to own a true own OC policy. And what that is that at the time of the disabling event, whatever your occupation is at that time, if you cannot perform the material or substantial duties of that specific occupation, a benefit is payable, you can still work, even if you can still work in the same industry. So, like for instance, I used cardiologists. So let's say you're a cardiologist, something were to happen, you're not able to continue to practice medicine as a cardiologist, but maybe you could go into family medicine. You can actually still you can receive and make a claim every month off of that policy, even though you're still working in medicine because you're working in a different specialty and a different occupation, even though it's still medical. Okay, so that is by far the biggest separator for the strength of the contract for healthcare professionals. You also want to know how they define a disability, and it's literally one word can make the biggest difference between whether this is a really strong contract or not. And it's the word or. It's the word or. So most contracts use the word and. And what I mean by that is they're going to require you to have a loss of time from work and a loss of income. Okay? Now, most disabling events are going to affect loss of time and loss of income. However, let me give you an example of the or. Okay? Let's say this is a client of mine. So I have a client that has MS and she is still working 1.0. She still works full time in her occupation. However, there's a large percentage of her income that is RVU based. And because she's not as efficient as she used to be, she's unable to see as many patients as she used to see, especially when she has flare ups. She's had a substantial loss of income compared to prior to her MS diagnosis. And so, because of that, she actually is able to make a claim and receive income off of her disability insurance policy every single month, even though she's still working full time. And it's because the or contract, it's a loss of time from work or a loss of income. So specifically those that have any percentage of their income based on RVUs, you want to make sure that the contract defines disability with a loss of time or loss of income. You also want to make sure that there is a partial disability rider, okay? You want to make sure there's a cost of living adjustment rider, right? Like $1,000 today is not going to spend the same in 10 years. Okay, so we need to make sure that this contract is keeping pace with inflation. Then also you want to have what's called a catastrophic disability rider. All right. Now, the simplest way for me to explain what that is it's basically long-term care insurance that's stacked on top of your contract. And the reason it's so important to have that with your disability insurance policy is because number one, it's way cheaper as a rider on your disability policy. It's way cheaper than purchasing a standalone long-term care insurance policy. But what this is in the event that you cannot perform, two of the six, two or more of the six daily functions of life, this is an additional benefit that would pay out. So let's say your disability insurance policy is a $15,000 a month policy, but then you stack on an $8,000 catastrophic disability rider. Well, now you would have the majority of those long-term care expenses covered with just the $8,000 catastrophic disability rider versus that, your long-term care expenses eating into the main benefit of $15,000 a month. Then you want to have a future purchase option. Specifically, though, if you're a resident, a fellow, military, or you're still relatively new into practice, you want to be able to only have to medically qualify for disability insurance once. And so if you obtain a future purchase option rider, that means you can get a little bit of coverage now, but down the road, you can purchase more coverage and you don't have to do a medical exam. There's no medical underwriting to get more coverage. And then the student loan rider, obviously incredibly important for those that still have student loans, that are still younger in their practice. Again, this would just be an additional benefit on top of the base benefit to help cover student loan costs, paying those back. So, the most common is $2,500 a month for 10 years or 15 years. And that's what most residents or fellows will obtain, because that is basically enough to pay off their student loans over that time period. Okay, so transitioning gears, I want to talk about liquidity. All right. And when we're talking about liquidity, we're going to talk about how most people's cash flow works, and solution, how most people should manage their cash flow. So what most of society has taught us is that we're gonna work, we're gonna make an income. That income is gonna get direct deposited into our checking account, and then from there we have our burn rate. Okay, our burn rate meaning the money that we burn every single month. It's not going to come back to us, right? So we've got our mortgage or rent, student loan payments, any other debt reductions or obligations we have. We've got our normal bills and utilities, we've got taxes, and then we've got our lifestyle, right? Just the day-to-day expenses of life. And then with whatever's left over, we then save or invest. Now, this is how most of society handles their cash flow management. And this is, for most of us, this is what our parents did, our grandparents did, okay? The problem, though, is that inflation has eroded income so significantly over the past several decades, is that this old method no longer works as an efficient way for us to build up savings and investments, because this is a spend first, save second model. And so what we believe is that we want to flip this on its head. And so we're still going to earn an income, but instead of having our income direct deposited into our checking account, we're going to set up what we're going to call a wealth building account, totally separate from where we bank at. So we're going to have all of our income going into our wealth building account. And then what we're going to do is we're going to pay ourselves a salary into our checking account. And that salary should equal our burn rate. Again, our burn rate is mortgage, rent, student loans, other debt reductions, bills, utilities, taxes, lifestyle. But the reason we're going to do that is because when we have all of our income going into this wealth building account first, and then we pay ourselves a salary, it's what's called a profit first methodology to cash flow management. But generally speaking, that over time, especially as our income grows, we find ourselves having more and more and more overflow for capital allocations, for savings and investments. And so when we do this, when we have this model in place, because this becomes more of a save and invest first, spend second, what I found working with physicians and medical professionals all over the country for nearly 2 decades is that their ability to build wealth and achieve financial independence at the rate that they want to achieve it becomes substantially more realized at an earlier time by having a save first, spend second cash flow model in place, similar to this one, than if they just traditionally do what we've all been taught to do: spend first, save second. And so this model, I've seen it time and time again with the clients that I work with, be able to achieve financial independence much more quickly. Okay. And then the last topic that I'm going to hit on today is going to be on diversification. Now, my disclaimer on this is that when it comes to diversification, most financial advisors, most investment advisors, most people that are in my industry, when they talk about diversification, if I were to poll every single one of you that are on this call and ask you to tell me what diversification means, 9 out of 10 of you would say it's like how balanced my portfolio is between like stocks and bonds and ETFs and equities, because that's what most financial advisors have taught. And the reality is that's where most financial advisors start and stop. And that's where me as a financial architect, as a wealth building architect, this is kind of where I get started. Okay. Because there are substantial other areas regarding diversification that matter almost as much, if not more, than what our portfolio diversification looks like. Okay. So, first and foremost, the most important form of diversification regarding building wealth has nothing to do with our portfolio, but it does have everything to do with tax diversification. Understanding what types of accounts we can get set up and understanding whether those accounts are going to be a tax now, a tax later, or a tax never, right? And so, tax never, the government limits what types of accounts we can set up that are going to be in the tax never bucket, okay? And so, the most common that people have heard of are Roth IRAs. So a Roth IRA is a tax never bucket. An HSA is a tax never bucket. A self-directed Roth IRA is a tax never bucket. Permanent life insurance, specifically the type that's been overfunded for cash value growth, can be utilized as a tax never bucket. A portion of a Roth 401k is a tax never bucket. But what most people are maximizing is the tax now and the tax later buckets. Time and time again, I meet with healthcare professionals, and all of their retirement assets are either in just a traditional, like a traditional IRA, a traditional 401k, and a brokerage account that they get a 1099 on every year. So that's the tax now and the tax later. Uh, but when you have true tax diversification that's built and a plan that's built around diversifying when and how you're going to be taxed, you can substantially minimize your tax bracket in your later years, in your retirement years, those years that you're going to be on more of a fixed income, those years that you either don't want to practice medicine anymore or you medically can't. And so you want to make sure that whoever you use, you're making sure that whatever your investments look like, you have a very diverse investment portfolio to ensure that you can minimize your tax burden down the road. There is a really good resource on this that I strongly recommend. It's called The Power of Zero. It's a phenomenal book. Highly encourage you pick it up, read it. But there's a lot of strategies that exist that are out there that can really lower your tax burden in the later years. So that's where I and my team get started. We're always going to start on tax diversification. Then we're going to look at portfolio diversification. And that's what people are most common with: stock, equities, bonds, cash. What does that ratio look like, right? Normally you'll hear something like, I'm in 80-20, or I'm in 70-30, or 60-40. Generally, all that means is that's the ratio you're in of stocks or equities and bonds or cash, right? So I'm in 80% stocks and equities, and I'm in 20% bonds and cash, right? The younger you are, generally speaking, the riskier you can be. So the younger you are, you can generally get away with being in an 80-20, 90-10, 100-0 type of type of portfolio. But the older we get, the closer we get to retirement, we've got to start backing off those stocks and equities and start increasing the ratio to the bonds and cash. The reason being is because we can't afford to lose money. We can't afford it. We don't have enough time, right? Somebody who's 60 and wants to retire at 65, they don't have enough time left working to be able to make up for substantial losses. And so generally what you'll see is, like I said, you'll start with more equities in our younger years and then lower that over time. And then last and definitely not least is asset class diversification. And unfortunately, this one gets skipped over by too many financial professionals that are out there. Generally, when people talk about investing, generally, they're always talking about marketable securities, things that have to do with the stock market, right? So stocks, bonds, mutual funds, ETFs, anything that is regulated by the SEC, right? Those are marketable securities. However, majority of the clients that I work with are considered what's called an accredited investor, meaning that you either make over a certain amount of money per year threshold, or you have over a certain amount of net worth. And as an accredited investor, you have options open to you, investment options that are open to you that are not open to the general public. Okay, and we call those alternatives. These are alternative investments. These are things like private equity. A lot of real estate deals are done in the alt space. Oil and gas is popular in the alt space. Apartment syndications or commercial syndications. Land deals, ag deals. I mean, the list really goes on and on and on and on when it comes to alternatives. And what I found, because I do work, primarily with entrepreneurial medical professionals, I find that they actually have almost more of an interest in alternatives than they do in marketable securities. And so, but making sure that you have asset class diversification. So, when we're looking at building wealth, we're not just looking at portfolio diversification, right? We are also going to be taking a long, hard look at tax diversification as well as asset class diversification to make sure that our wealth building curve can be achieved either when or before we want to be able to achieve it, and make sure that it's got all of the protections in place to being able to reach it. And so that's the majority of my content that I have for the piece today. And I know Angie is going to come on and talk a little bit further about next steps and what the strategic wealth system model looks like.
All right. Thank you, Bill. That was really great. So let's talk about next steps. I want to cover briefly what our strategic wealth system model looks like as we partner with a client. It's really starting off with the foundation of tax minimization, and then also getting you to a level as we do tax planning where you feel you have control of your money, have a true understanding of your finances and tax planning. And then lastly, and the most important part here, is the financial independence, which I think we're all seeking. So our goal with your tax planning is to get you to the top of this pyramid sooner rather than later. So our process as we work with a client works in 3 steps. I will just do a high level overview here, but we would first start off with a strategic tax blueprint. That's really where we're going to work with you to design a full roadmap of how your tax planning needs to go. And then if you love everything after we present your strategic tax blueprint, we move on to onboarding and implementation, developing all of the data and getting you set up with our firm. And then we will move into year-end tax planning. So I would love and welcome anybody to schedule a 30-minute introductory call with me. It will give me the chance to get an understanding of what your tax scenario looks like, your tax situation, establish where you want to be, and then I can also tell you a little bit more about our tax planning process, which is quite unique. So please use the QR code to schedule with me. I think they're also providing a link if you'd prefer to do it via that link, and then we can meet and chat and talk about next steps. And then we can't end the webinar without talking about the Richest Doctor book, which our David Auer wrote. It's really informative. I think most people find a lot of great information in this book. You can download the first 2 chapters for free. And then you can also go in and order the paperback as well if you love everything, and I promise you will. So I'm going to open it up to questions. Hopefully we have some good ones today to present to our speaker, Bill. Let's see what we've got. Okay.
I've got a question from someone who couldn't make it and asked that I
Sure.
ask on their behalf.
Mhm.
Let me just pull it up. So for the average provider who's making around 250K of 1099 income, how effective can these strategies be for this person in terms of savings? I know it's like a kind of a broader question, but I guess how effective can it be for someone who makes about $250,000 in 1099?
Yeah. So that's a great question, and I know David can probably speak to it as well. But I'll start, and I'll let David finish it up. So, $250,000 a year in income of 1099 versus W-2, there are a substantial amount of tax planning that can be done. Uh, a substantial amount. And so when you look at somebody that is pure W two, there's a large amount of that 250 that's going to be going to the government, and we can actually reclaim that through David through the tax blueprint. You can reclaim a large amount, if not all, of those tax dollars that can then go towards savings and investments, and they can be applied through a really well diversified portfolio with your portfolio tax diversification as well as asset class diversification to achieve financial independence at a much younger age than had they been W-2. So there's a lot of planning, but generally we help them start first with tax planning because that's where you can reclaim a large percentage of the money that they currently have going out. David, I don't know if you want to take that a little bit further.
Yeah, I'll add a couple of things. So definitely, tax planning really starts when you have some business type income, which would include 1099 income. Basic things like earning that income through an LLC or a corporation that's taxed as an S corporation is going to allow you to mitigate some otherwise self-employment tax. You've got, if you have a separate entity, you're going to have some low-hanging fruit deductions. You could also add to that things above and beyond what you normally would spend out of pocket. At 250,000, you're not in the highest tax bracket, but you're still in enough of a tax bracket to make tax planning, valuable or beneficial. When you add the whatever the self-employment tax is that you're mitigating, your federal marginal bracket that you're in, depending on whether you're single or married filing joint, and then if you live in a state that has a state income tax, so they can add up and still make it worthwhile.
Yeah, absolutely. Great question.
Right. We do have another question from the audience. Is the party over for conservation easements, either historic or land?
Well, the party's over if you want to get ahead tax-wise by investing in a conservation easement. Under the statutory change that took effect this year, your maximum charitable contribution can only be 2.5 times your investment. So it used to be appraisals were done at 4 to 5 to 6 times the investment, depending on your tax rate. That usually resulted in a tax savings that exceeded the investment. When you take now that the limitation is 2.5, and this is a syndicated conservation easement that I'm referring to, not other types of conservation easements. When you multiply 2.5, and then you multiply that by a 40% tax rate, you're just breaking even. So unless you otherwise would want to give that money away or invest that money in a conservation easement, then you're just really going to break even on your tax return. Now, with that said, if you own a farm or a ranch, or you have an investment property that you do not think will ever be developed, you can continue to use it as a farm or a ranch, but just not for commercial or residential development. It may make sense to do a conservation easement, especially if it's a floodplain or a creek bed or a grove of trees that you want to keep intact or green space. In that situation, then that is not subject to the 2.5 multiple limitation. So it's whatever the highest and best use fair market value of that property is, and depending on your tax rate, that could still be that could be beneficial.
Yep.
Great. And we have another question from a viewer. Do I need to regularly review the Comdex score of my insurance company?
I would say no, or yes and no. All right. So it's kind of a trick question, right? Because it is important, although it is very important to know what is the financial strength of the insurance company that, in the event you have a disabling event, would be paying out a claim to you. There's also time is not on our side when it comes to the investment that we have to make, right, for the premiums to be able to obtain that coverage. And so, you may have purchased it 5, 6, 7 years ago. Well, even though the company maybe isn't as strong today as they were then, um, uh, it may your premiums may go up by 50% to change companies. So it may not make the most sense. What I will say though is really when it comes to healthcare professionals, there's really only about 5 carriers that are out there that makes sense for a healthcare professional to own. So there's really only about 5, based on the strength of the contract, how everything's worded in the contract, and the Comdex scores. There's about 5 companies, and so with our firm, I mean, we're always going to look at those 5 companies and figure out put them in competition amongst one another, and see who can give the client the best offer based on their medical rating. But once you've owned the contract for a decent amount of time, I think it's important to be educated about what their Comdex score is, but as far as making a change, probably, if you've had it 5 or more years, it may not make the most sense as long as the contract itself is a strong contract, it may not make sense to make a change because the trade off for the cost of the premiums may not be worth it.
Right. Looks like that was the last of our questions. Thank you, everybody, for participating. I do want to remind everyone that we are going to send out a recording of the webinar today, so look for those in your inboxes soon.
All right. Thank you, Bill. Thank you, Provident team. And thank you, everyone who was able to join us. Have a great evening.
Hey, thanks so much.
Thanks, you too.